Hey, hello friends. I'm Ankit, and this is my very first tutorial that is about to begin. Before beginning with the tutorial, let me just introduce myself and a brief about the tutorials. Basically a chartered accountant, and the reason behind making these tutorials is just to share my personal practical experiences or knowledge or learning with everyone who would be watching these tutorials. And I'll be really happy if someone could get benefited out of it, or someone could learn something out of these tutorials. Uh, these tutorials would be dealing with various aspects mainly into investment, various kinds of investment products like LIC, mutual funds, how many types of LICs are there, mutual funds are there, which are good options to uh, buy, and tutorials relating to Excels, etc, etc. So in today's tutorial, I'll keep it very simple and basic, as it's my very first tutorial. So in today's tutorial we'll be talking about insurance policies. I hope everyone must have heard about this term sometime in their lives and in today's world as well. uh, Everyone needs to have an insurance policies done. Okay, so in today's market there are basically three types of insurance policies available. The first one is very familiar and very known, especially uh, to people before we I could say some 5, 10, 15 years back. These policies are very much renowned, which is called as endowment policy. uh, what there in these policies are in these policies you are required to pay a specific amount of premium every year for a sum assured which you select for yourself. That suppose you have selected that you want a policy of 40 lakh rupees, so you'll be paying every year around 1 lakh rupees premium for the duration of the policy, which is generally to a maximum of 30 years. So you'll be paying these premiums till 30 years, and at 31st year you will get a lump sum amount, which will include your sum assured amount plus the bonuses given by the insurance policies. Also, in case any mishappening happens between the duration of the policy, you'll be given the sum assured amount, or actually your beneficiaries will be given the sum assured amount. There are various other kinds of yeah, aspects which is included in endowment policy, like if there is some mishappening regarding with respect to like it's because of some accident, then there is some extra amount is paid, and various kinds of new things are introduced in the endowment policies as well. One important thing about endowment policies is that when your duration of the endowment policies ends up, that is, suppose in as per my example, at the 31st year you get the a lump sum amount. So the lump sum amount, the part of your sum assured, the policy you have taken is fixed, that you'll whatever policy, whatever sum assured policy you have taken, this policy will be paid to you. And in our example, I have just taken as 40 lakhs, so 40 lakhs will be paid to you. Over and above 40 lakhs are the bonuses, and the bonuses parts is are not fixed, and it is nowhere mentioned that this much bonuses will be paid to you. So there are fluctuations in the bonuses, that sometimes it may go to 80 lakhs, or sometimes not to 80 lakhs than 75 lakhs, or it may be 85 lakhs also. So there is a pretty much variations in the bonuses which they pay, but more or less the overall return which is earned over endowment policies is around 6 to 7%, which is being calculated generally that this is what the return you get out of the endowment policies. Second type of policies is known as money back policies. Money back policies are a mixture of endowment policies and term insurance policies. So before understanding money back policies, we just have to know about what are exactly are term insurance policies. These are very much in limelight nowadays, or since past a few years. These are the very demanding insurance policies. What term insurance policy are? They are the basic insurance policies, and they deal with the basic requirement of insuring life of someone without thinking insurance as an investment, or without thinking insurance that as an instrument to put your money into and get a return at the end of its duration. So in term insurance, you pay a fixed amount every year, and if something happens to you during the duration of the policy, then the sum insured amount will be paid to you. If nothing happens to you and you are good enough and everything goes well, so and nothing will be paid back to you, and whatever premium you have paid will be lapsed and it will be taken away by the insurance company itself. So on the face of it, it looks like a very disadvantaged policy, that whatever you are paying, you'll be only be getting something if something happens to you, and nothing will be paid to you at the end of the policy. But because of such a nature, the premium amount of these policies are very small. If I give an example, then as I've said, in endowment policy, if you have to buy a sum short of around 40 lakhs, the premium will be around 1 lakh or 1 lakh 12,000 yearly basis, and the same premium in the term insurances will be around 8,000 rupees a year. So this is where the differentiation comes, to make it understand more nicely that how term insurance is and why term insurance is getting more popular nowadays than endowments. I have also taken up a small example. I'll do the example after explaining what money back policies are. So, and that will give you a much more clarity to how to select between these endowment policy or money back policy or term insurance policy. So coming back to money back policies are a mixture of endowment policies and term insurance policies. If I give an example, is that in money back policy you pay a specific premium amount for a duration of the policy, and at the end of the duration of the policy you will get whatever you have paid. Like for example, if you are paying, suppose, 30,000 per year for a policy of 40 lakh rupees, so at the end of the period of up to suppose 30 years, you'll get whatever the submission of all the 30,000 that you have been paying over the 30 years at the end of the policy. But the difference between a money back policy and endowment comes at that, is that you will not get any bonuses along with your sum insured. So this is a major difference between a money back policy and endowment policy, and because you will not get any bonuses at the end of the policy, the premium amount of money back policies are much lower as compared to endowment policies. Okay, so I hope the basic over the types of policies policies are the basics are very quite clear, that what is endowment policy, what is money back policy, and what is term insurance policies. Now I'll take up a very simple example to illustrate or to make it easier for people to select which kind of policy they should opt for, and why especially the term insurance policies are getting more popular nowadays. Although I have put it up with that example, just a second. I show you the example. Instead, I have taken up this example, and I'll be doing it in a separate Excel sheet as well. I'm just showing you how it will go along. So what we'll be doing is we'll be making two scenarios. One is if I opt for a simple endowment policy, what will be my cost and what will be my return, and we'll make another scenario in which we'll take a term insurance policy, and with the term insurance policy we'll invest that some amount in some other investment instruments as well, and we'll see how much return we'll earn. So let me begin. Let's say scenario number one. Scenario number one is I buy a endowment policy. Okay. So endowment policy, and we suppose we take a duration of around 30 years. The policy is taken for 30 years. Okay, and amount invested on these policies, which is according to me is approximately for an LIC, Life Insurance Corporation, is around 1,12,000 for a 40 lakh sum assured. So what we'll be doing is dragging it up to 30 years. Okay, it's 20 and 30. Yeah, so in 30 years I'll be paying 1,12,000 every year. I hope everyone is getting what I'm doing. So I'll pay 1,12,000 for a next 30 years, and the policy is of 40 lakh rupees. Okay, the policy sum assured, I just write it here, is sum assured is 40 lakhs. Okay, so 40 lakhs is a sum assured. At the end, that is at 31st year, if I before 31st year, let me just calculate what will be the total cost that will be there. It will be all equal to sum 3 lakh what is 33 lakh 60,000, right? So 33 lakh 60,000 is the total cost which will be coming. So some might be wondering how come it's 33 lakh 60,000 for a 40 lakh policy. So let me just explain. There is incentive being given by the insurance policies that if you pay the premium amount on a yearly basis, you will get you will have to pay a amount which is lesser than if you pay it on a monthly basis. Like for example, if you start paying 1,000 rupees for every month, which counts to 12,000 rupees a year, and instead of doing that, what you could do is you could pay 11,000 rupees in total for the whole year, and it will save you rupees 1,000. And similar is the case if you want to opt for a quarterly premium, then there will be a little less advantage than paying a yearly premium. So we'll not get into the nitty-gritties of it, that how it is being calculated and what it is generally like. If you have not if you are giving the whole of the amount on a yearly basis and you are not keeping that amount in a saving account, whatever you will be earning in that saving account, if you have kept that amount in a saving bank, will be paid to you, and that's why the whole adjustment is there. So because of this, the policy what we have taken is of 40 lakh rupees, and by premium, as I've taken that's an approx premium, so it might be somewhere more or less also around. So we'll take it as 33 lakh 60,000 will be the total cost, and what I'll be getting in the 31st year will be 40 lakh rupees for sure. I'll be getting 40 lakh rupees if nothing happens to me, and in case something some mishappenings is there, so in between during these 30 years you'll get the 40 lakh rupees, plus if there you have opted for any incentive plans as well. But if everything goes well, at the 31st year you'll get 40 lakh rupees plus the bonuses. Although the bonus part is not fixed, and it's quite variable, but we'll assume it to be a double of what is the sum assured, so we'll keep it at 80 lakh rupees, because if you consider around 6 or 7% interest for these many years, it comes to approximately double of your sum assured amount. So somewhere near it or like this only. So 80 lakh rupees will keep it. So it's 80 just a second, 80 lakh rupees, yeah. Okay, so it's 80 lakh rupees, and this is what you'll be getting. Now what we'll be doing is we'll take a second scenario. In the second scenario we'll put that we take up a term insurance. Okay, term insurance. Okay, so in term insurance, what we'll be doing is we'll be doing a similar kind of exercise, so that we could compare which is a better option to go for. Okay, so I'll do the same thing here, 1 2 and drag it. Okay, come on, drag it up to 30 years. This, and so now in the sum assured amount, if what I'm doing here for the sum assured amount is that I'm assuming that after 30 years what the total benefit that I'll be getting here will be 80 lakh rupees. So keeping that 80 lakh rupees in mind, I'll take the same, that in case something happens to me during this the tenure of the policies, I should get 80 lakh rupees from the term insurance as well. So instead of keeping the sum assured amount to 40 lakhs, I'll keep it at 80 lakhs, because there is nothing called bonuses in the term insurances. Okay, and in endowment there are bonuses. So the sum assured is 40 lakhs, but if something happens to you, or otherwise nothing happens to you, and you survive the duration, then you'll be getting 80 lakh rupees. So I'll keep the insurance, it's a sum assured here, as 80 lakhs, that in case something happens to you, then your beneficiaries will be getting amount of rupees 80 lakhs. Okay, we'll calculate the premiums and everything based on 80 lakhs, because the return what you're getting in an endowment policy is of 80 lakhs. So I've kept the similar kind of return, that in case if something has happened to you in endowment policy, you'll get 80 lakhs. In case something has happened to you in insurance in a term insurance policy, you'll get 80 lakh rupees. Okay, so for a sum assured of 80 lakh rupees and term insurance, you have to pay a premium of approximately 8,000 rupees a year. A very small amount as compared to endowment policies, right? So we'll say keep it as 88,000 rupees for 30 years. If we calculate its total cost, so it comes to around it is around 2,40,000 in 30 years, right? Now so the total cost here is 33,60,000. Cost here is 2,40,000 for the same amount of benefits that they'll be getting. Now the difference comes is that you will be getting the amount what you have paid in an endowment policies back plus bonuses, but the same is not there in the case of term insurance. So what we'll be doing here, that along with a term insurance, we'll put our money in PPF account. And for a better comparison, what I'll be doing here is, I'll suppose that I have a total amount of rupees 1,12,000 only in my hands, and so I'll compare that if I put that 1,12,000 completely into endowment policies, what will be the return I'll get, and similarly that 1,12,000 I'll distribute between the term insurance and PPF. and I'll calculate the return that what I'll be getting from there. Okay, so how it will be done is that I have a total amount of 1,12,000 only. I've spent 8,000 rupees in my term insurance, so rest remains is 1,12,000 minus 8,000. Okay, so 1,04,000 I'll be investing regularly in, regularly I mean on a yearly basis in PPF. And for your information, the PPF account currently earns a rate of interest of 8.75%. Okay, 8.75% is the interest being is the current interest rate of PPF account. So if we put 1,04,000 rupees every year in PPF account and 8,000 in term insurance, what will be the total benefit that will come to us at the end of 31st year? That is what we are gonna calculate now. So what I'll do is that 1,04,000 multiplied by 8.75% of interest that will be accruing every year. Okay, and which gets to 1,04,000 plus 9,100, that is 113,100 is the amount which will be carried forward for the second year. Right, in the second year there will be it will be 113,100 plus an additional amount of 1,04,000 made to PPF again. Okay, and similarly 8.75% interest on 217,100, and similarly the trend will goes on. So what I'll do is I'll just drag it here, see, like this. So I'll now what I'll do is I'll fix this cell, that is okay, I've written here is 1,04,000 rupees. So this 1,04,000 will be invested every year. So what I'll do is I will just drag the cells till 30 years to know what is the actual position at the end of 30 years. Okay, just a second. Okay, like this. Okay, so this is nothing but just compounding that 1,04,000 I invest every year, I get an interest of 8.75% every year, and this gets carried forward every year, and at the end of 30 years what is there in my PPF account is approximately 1 crore 47 lakhs 15,261 rupees. It's 1 crore and it's 80 lakhs here. Okay, I know the fact that PPF is available for period of 15 years, but there is a provision that we could continue our PPF even after 15 years. So it's just made on a simple assumption, because, and I've taken PPF account because PPF account is something which gives you an assured return, 8.75% fixed, no fluctuations, nothing, it's assured by the government. Okay, so in case if you're not investing in PPF, you invest in mutual funds, you invest in equity, and you get a return of 15% or 12%, the amount will be even much higher than this. So if I have to calculate a net benefit in term insurance, then it will be 1 crore 47 lakh 15,261 minus what I've invested in term insurance, which is 22 lakh 40,000. So net what I'm getting will be 1 crore 44 lakh 75,261 as against 80 lakh rupees in an endowment policy. And if I calculate the difference between the two, it comes to 64 lakh 75,261 rupees in an year, in an 30-year bracket. There's such a difference, big difference between an endowment, going for an endowment policy, and going for a term insurance policy. Okay, so I hope things are pretty clear in everyone's mind that why the term insurance policies are getting more popular, because first reason being it involves a very small amount of premium. It gives you the same sum assured, especially it gives you the actual insurance what you want, not providing you an investment objectives from where you invest for returns. it provides you a insurance for your life and to cover or safeguard your life only, and not providing your life as an investment instrument. Secondly, while you put a very small amount in term insurance, the investment amount in endowment policy is quite high. So in term insurance you also get a benefit of liquidity. You get 1,04,000 rupees extra, which is PPF, which I've invested in PPF here, to invest in anything that you want to. If you feel like the stock markets are going good, you could put that amount there. You would think here the interest rates in FDs are good, you could put their amount there, or XYZ instrument, and you can earn even a higher interest than what is there in PPF, which is I've assumed is 8.75%, and the overall return will be much higher than what has been calculated here. So this is a very simple example that I've taken up to make you understand how what is the difference between endowment policy and term insurance policy. I hope everyone is has got an idea of what I have been talking about in this entire video. I'll be wrapping up this video and this tutorial now, to not to make it too long now. So I hope everyone has liked this videos, and just pardon me for any discrepancies, being it's being also been my first tutorial. So just take a look around, and if there's something, you can always reach up to me, or you can put up your comments in the below here, and let's meet up in the next tutorial. Okay, till then, bye bye, have a nice day.